talk about the new kid on the block, truck operating platform Zinka Logistics. Saw a decent debut, listed at about a 3% premium to its issue price, but thereafter saw a bit of a sell-off, currently sitting at a 3% discount to its issue price as well. To discuss the company's post-listing plans, we have Rajesh Yabaji, the CMD and CEO of the company, joining in. Rajesh, congratulations. A momentous day for your company to be listed on the bourses, irrespective of today's moves. You know, it is definitely a moment that you will remember with all your teammates as well. But let's talk business. Let's, tell us a little about your current revenue mix across load management, payments, vehicle financing, and what are the kind of take rates / margins that you make across all these verticals?
So thank you so much for having me on the show.
Yeah, go ahead.
Thank you so much for having me on the show. Right. Sorry. Yeah. So, as a company, as you're aware, we are a company which is, which dreams about like trying to build a new world of trucking. And, to get there, we as a company are trying to solve the problems for the fleet operators in the country using a platform approach, helping them, get digital, helping them simplify their operations, and get more earnings by using the technology platform which BlackBuck has built. And as a company, I think, our core offerings of payments and telematics, which were basically the first launched offerings initially, form a large part of the revenue as even mentioned in our prospectus, right? And because of the nature of businesses we are in and the nature of revenues, what we make is largely technology kind of revenues, platform kind of revenues. Most of these come at a very high contribution margin of like 90 to 93%. And because of the nature of these revenues, which have high level visibility, because you acquire a customer, you know that the customer is going to be there on the platform for a very long tenure of like 5, 7, 10 years. And then there's a high visibility of revenue. And these revenues are generally recurring in nature. So you don't need to really invest in substantial amount of sales and marketing. Every time you generate revenues, we only, put sales and marketing to generate newer customers to the platform. The older customers continue to, compound the revenue. Because of the nature of, the business, the technology, based revenues, our contribution margins, in any business sort of range between 75-80% to as high as 99% with a blended contribution margin profile of 90 to 93%.
Right, Rajesh, but the stock market likes cash flows, the stock market likes EBITDA, the stock markets like net profits. Despite the high contribution margin that you're talking about and large market share, you're still EBITDA loss making, operating cash flow negative, and your first quarter net profit too has come in from exceptional gains. So you want to understand about that, while you are acquiring customers, that too at a high contribution margin, there is operating leverage playing out with visibility, etc. That's not showing in your numbers in terms of at least the operational profits or the net profits or even the operational cash flows. So could you give us a sense of when you intend to be positive on all these fronts?
Yeah. So number one is we as a company are PAT profitable in the first quarter, even without the exceptional item. That's point number one, including all costs, ESOP costs, everything, number one. Number two, operational profitability, which we measure through adjusted EBITDA, which is also the indication of cash flows. We have been fully profitable for the last financial year, and we made close to about 19 crores in, adjusted EBITDA in the first quarter. And our cash flows, like last financial year, with an adjusted EBITDA of, about 13.5 crores, we made a free cash flow of 45 crores. So because of the nature of revenues we have, our adjusted EBITDA is what mimics the, free cash flows. So as a company, we've been consistently throwing, money in cash flows, over the last, 4 to 6 quarters, and we'll continue to do that. And because of the nature of revenues, and the operating leverage, because if you can see, last financial year first quarter and this financial year first quarter, the growth in contribution profit flew down into the, EBITDA margins, like with an efficiency of like 75%. So that, kind of a play is going to happen as we keep building the company, and that will drive consistent profitability, of the company as we step into the future.
Rajesh, good morning and welcome to the show. This is Nigel on this side. You've given us a fair insight into business, take rates, contribution as well. Give us two numbers. The sustainable growth rate that you're looking at, that's on the revenue front. And according to your calculation, what should the margin look like?
Yeah. So, can't comment obviously on the future numbers. If you look at...
Why? You can give us an aspiration, Rajesh. Now you're listed, you can give us an aspiration.
Sure.
Nothing wrong with that. Regulators are going to be okay.
Of course. As a company, we've grown in the first quarter close to about 60%. Last year, we grew like 70%. So we continue to compound on growth. Customers keep, we get acquiring customers at a, better pace, similar paces as previous years. And so growth is the mantra. We, as you guys know, we operate like multiple different service offerings. And today the revenue largely comes from only like 2 core offerings. The remaining offerings are scaling at a very fast pace. So you can definitely expect the revenue to, keep compounding, on the similar lines. And if you, put a math on operational leverage there, because the company, really is not investing in, factories or does not have like assets, because, the ROE of the company is going to be, very high because there is no deployed assets in the company as we keep moving forward. So using the operating leverage methodology, you can, you will be able to understand where we will be in the steady state margin profile.
Got that. Take that point, Rajesh. Thank you so much for joining in. What we'll do is we'll probably invite you once again for a longer conversation to try and explain to us what your business is, more importantly, how the operating leverage plays out as well. But for now, straight, we'll just look at 50-60% growth. All right.
Absolutely. All right. Thanks, Rajesh, for joining in and filling us in with all of those details.